Hello guys, and welcome to the beginner's guide to forex trading episode 2. So in this episode, I'm going to be teaching you about forex brokers, the different currencies and currency pairs, leverage, forex lot size, pips, bid and ask price, and then spread. So if you already like what I'm about to teach you, kindly hit on the subscribe button, turn on the post notification to be the first to receive our videos. Stay tuned till the end. Okay, so let's look at forex brokers. Okay, so talking about forex brokers, we have two major types. We have the dealing desk and then we have the non-dealing desk. But today we are not going to look at that. We are just going to see the basics of a forex broker. So now let's start. Who is a forex broker? Forex brokers are firms that gives you access to the forex market. They are like middlemen between traders and the interbank, which is a global market that allows you to trade foreign currencies. So now let's look at some of the examples of the brokers. So the examples of the brokers are: the first one, we have XNES. Number 2, we have FBS. Number 3, we have IC Market, and then we have a lot, thousands of them. Okay, so how to select a forex broker? So in selecting a forex broker, you must consider the following. That is, number 1, their regulations. Okay, so when selecting a forex broker, you need to pay attention to the regulatory board that is regulating them. For example, we have the MAS, that is the Monitoring Authority Singapore. The Monitoring Authority Singapore regulates most brokers. They are one of the best regulatory boards, good for regulating brokers. So it's good when you go with a broker that is being monitored or regulated by the MAX. Okay, so the next one, their execution. So you need to watch out for how your trades are being executed in the market. You need to watch out and see whether your positions are instantly placed in the market or they delay for a few seconds. You need to check out for all those things to be sure of their execution before you go with them. Okay, customer service. Okay, so with some of the brokers, if you have challenges and then you chat their support team, they will take days to return back your message. They will take days to reply you. So it will be good if you go with a broker that when you chat them, they will reply you in the next 24 hours should be mass. Okay, so the next one is ease of withdrawals. Okay, so when choosing a broker, you need to check for their ease of withdrawals. Personally, I work with so many brokers, and then one thing that I notice is that when it comes to deposit, you are not going to face any issues when depositing with brokers. But when it comes to withdrawals, that is where you're going to find a whole lot of issues. That is my experience with most brokers. You need to watch out for their ease of withdrawals before you go with them. So let's move to the next one. Okay, so the different currencies and currency pairs. The currency pairs. In forex, currencies are traded in pairs. The first currency is called the base currency, and the second currency is called the quote currency. For example, we have the Euro USD. So the Euro is the base currency, whilst the USD is the quote currency. Okay, so there are 8 strong economy, that is currency that plays major role in the financial market. So in the financial market, we have 8 strong economy that plays major role. So let's look at them. The first one, we have the Euro, followed by the USD, and then we have the GBP, that is Great British Pound. We have CHF, that is Swiss francs, and then we have NZD, New Zealand dollar, and then we have AUD, Australian dollar. We have CAD, that is CAD, Canadian dollar, and then we have JPY, that is Japanese yen. These are the 8 strong economy that play major role in the financial market. Okay, so let's move on. Okay, so let's look at the type of currency pairs. So we have the major, minor, and then we have the exotic. Okay, so major pairs. there are 7 major pairs in Forex. So the first one we have Euro US dollar. And then the second one we have GBP USD, that is Pound US dollar. The third one we have AUD USD, that is Aussie dollar. The next one we have NZD USD, that is Kiwi dollar. The next one we have USD CHF, that is dollar Swiss. And then followed by USD CAD, dollar Loonie, and then we have the last one USD JPY, that is dollar yen. These are the 7 major currency pairs. Okay, so another way that you can easily get these 7 major pairs is, let's go back, let me teach you something. Okay, so for example, we have 8 strong economies, which we have the Euro, USD, GBP, CHF, NZD, AUD, CAD, and then JPY. So in this 8 major economy, just take out the US dollar and then match it with each of them. Just match it. So it will be Euro US dollar, GBP US dollar. So you should just follow that format, the arrangement. Just take off the USD and then match it with each. That is how you easily know the major currencies. So we have the Euro US dollar, GBP US dollar, AUD USD, that is Aussie dollar. We have NZD USD, USD CHF, we have USD CAD, and then USD JPY. So we just take off the USD and then we match it with them. Okay, so let's look at the minor pairs. So these are pairs that do not have the USD element to it, or they do not have the USD element in them. Okay, so for example, we have the Euro crosses, which the first one we have Euro CHF, Euro GBP, Euro CAD. And then we have another example of yen crosses, and then we have CAD JPY, AUD JPY, and then we have NZD JPY. And then the next one, let's look at some pound crosses too. We have GBP AUD, GBP CAD, and then we have GBP NZD. Okay, so the next one, let's look at the exotic pairs. So these are pairs that are scarcely traded. And then in other words, the combination of one of the 8 major currencies and a currency from a developing or emerging economy. Okay, so let's look at some examples. So for example, we have the USD ZAR. The ZAR is for the South African. And then we have the USD MXN, which is for the Mexican. And then we have the USD TRY for the Turkish. Okay, so all developing economy attached to any of the 8 major currencies can be referred to as exotic pairs. For example, we have the USD Ghana cedis, and then we have the USD Naira. They are all exotic pairs. So let's move on. Okay, so our next topic, we are going to look at leverage. Leverage is the ability to use something small to control something big. In the case of Forex, using a small capital base to control a larger lot size. The principle of leverage is virtually multiplying that your small little capital so that you can use it and buy something worth a bigger value. Okay, so let's look at some examples. So examples of leverage, we have 1:100, 1:500, and then 1:1000 leverage. Okay, so let's look at the calculation of a leverage. So to calculate a leverage, if you have 100 USD and you choose a leverage of 1:10, the leverage here is calculated by multiplying the 100 USD by 10, meaning you can control 10 times your initial capital, which is 100 USD. That is what makes the profit we have in Forex appreciable. Yeah, so that is the concept about leverage. Okay, so you are just going to multiply your initial capital with the leverage that you choose. So automatically that will be the money that you are trading. So all this thing happens at the back end of the broker. So it is the broker that will give you leverage to trade with. Yeah, so all this happens at the back end of the broker. Okay, so let's move on. Our next topic is forex lot size. So it refers to how much of forex currency pair you can buy. So under the lot size, we have standard lots, we have mini lots, we have micro lot, and then we have nano lot. So under the unit, we have 100,000 units, which I will explain everything here. We have 10,000 units, we have 1,000 units, and then we have 100 units. Under the volume, you have 1.00, 0.10, 0.01, and then we have 0.001. Okay, so for you to be able to open a volume of 1.00, you need a unit of 100,000. That is 100,000 units to be able to open a volume of 1.00. So in our previous calculation of leverage, which let's go back and see, which we multiplied 100 by 10, that is 1:10 leverage. At the end of the day, we have 1,000 as what we are trading at our back end. So meaning we have capacity to trade 1,000. So let's see. Okay, so when you check the unit column for 1,000 units, the broker will allow you to open a volume of 0.01. That is all the broker will allow you to open. Another example, when you have 100 USD account and then you choose a leverage of 1,000, the broker is going to allow you to open 1.00. Okay, so when you multiply 1,000 leverage with your 100 USD capital, you are going to get 100,000 at the end of the day. So with 100,000 units, you'll be allowed to open a volume of 1.00. So your broker will then allow you to open a volume of 1.00. So that is about leverage. So your leverage affects how much volume you can open. Okay, so with one volume, when we have a pip movement, that will be 10 USD. And then with 0.1, if we have a pip movement, that will be 1.00. And then with 0.01, when we have a pip movement, that will be 0.1 cent. And then with 0.001, a pip movement, that will be 0.01 cent. Okay, so let's move on. So pip is the smallest price movement in a currency pair. It simply means point in percentage. Okay, so let's move on. How to calculate pip movement? For most currency pairs like the major and the crosses, we consider the fourth decimal place. For example, Euro USD trading at 1.2511. If Euro USD move, that is number one, 2 pips up. Okay, so this is how the calculation will be. That's Euro USD 2 pips up. That will be 1.251, and then we will add 2 to the fourth decimal place. That is 2 plus that 1. So now our Euro USD 2 pip movement to the upside will be 1.2513. That will be 2 pip movement to the upside. Our concentration is always on the fourth decimal place. So 2 pip movement to the upside, you add 2 to the fourth decimal place. And then in that case, our fourth decimal place there is 1. So we are adding 2 to that 1, making 3. So our final answer will be 1.2513. Okay, so the second one, 2 pips down. That's Euro USD 1.211. Okay, so in that case, what we are going to do, the concentration is on the fourth decimal place, and then we taking 2 from 1 is not possible. So we are going to consider the 2, that is the 11, that the 1 that is there. So we are going to consider that 1. So taking 2 from that 1 will give us 9. So our final answer will be 1.2509. Okay, so let's move on. Okay, so let's note this. For the JPY pairs, we consider the second digit after the decimal point. So for the JPY pairs, we don't consider the fourth, we consider the second. Okay, so let's look at some examples. If Euro JPY is trading at 120.10, if Euro JPY move, that is the first one, 5 pips up, then let's look at what will happen. So Euro JPY moves to the upside with 5 pips. So that will be 120.1, and then we're going to add 5 to the second decimal point, which is the 0 there. So 5 plus the 0 is going to give us 5. So that will be Euro JPY will be 120.15. That will be 5 pip movement to the upside. Okay, so that's when Euro JPY moved from 120.10 up with 5 pips. Okay, so let's look at the second one, which is 5 pips down. Okay, so Euro JPY at 120.10, 5 pip down, you are just going to subtract the 5 from the 10, because we can't subtract the 5 from the 0. So we subtract the 5 from the 10. So this will give us 120.05. That will be 5 pips counting to the downside. Okay, so let's move on. Okay, so let's look at bid and ask. Bid is the price you can sell at, and then ask is the price you can buy at. Okay, so let me explain into details. So bid price is the price that your broker will give you to sell at, and then the ask price is the price that your broker will give you to buy at. Whenever you are trading, there is always bid and ask price given. So your choice is always made on the direction that you want. For example, if you want to buy the market, then you are going to consider the ask price. But when you want to sell the market, you are going to consider the bid price. Yeah, so let's look at some examples. So example, we have 1.2001 stroke 1.2003. So the bid price in this is the 1.2001, and then the ask price is 1.2003. So the higher value is always the ask, and then the smaller the bid. So please kindly take note of this. The higher value is always the ask, and the smaller the bid. Okay, so let's move to the next one. Okay, so the last but not the least is the spread. The difference between the ask and then the bid is the bid ask spread. So for example, if we have 1.2001 and then 1.2003, the difference there is 2. Because when you subtract 1.2001 from 1.2003, the difference will be 2. You'll be left with 2. So the spread here is 2 pips. So this is what the brokers charge, and then this is where the brokers make their money from. So the brokers make the money from the spread that they charge. So this is where they make their money from. Okay, so we have come to the end of our second episode. So if you are viewing this channel for the first time, kindly consider subscribing to this channel and then turn on the notification bell to be the first to receive our videos. Watch out for episode 3. Bye bye.